Right, this is part 11C, stock dividend splits and market cap. As we talked about in the last video, sometimes corporations will distribute profits to the stockholders as a way to give them a return on their investment. But there are times when companies, corporations in particular, they don't want to distribute the profits. Maybe they can't, maybe they don't have enough liquid capital, and so they do something different. Okay? They do what is called issuing additional shares of stock, and this is what we refer to as a stock dividend. Now, stock dividends are generally listed as a percentage. The percentage is multiplied by the number of outstanding shares to determine how many new shares will be issued. For example, the company may issue 10% stock dividend or 100% stock dividend. Stock dividends are classified as either small stock dividends or large stock dividends. So let's take a look at how that works. Let's say that our company here, Carl's Canoes, has 10,000 shares outstanding. Here are our stockholders, and if the company has 10,000 shares outstanding and they decide to issue a 10% stock dividend, then they would be issuing 1,000 new shares. This would be considered a small stock dividend. But if the company decided to issue a 100% stock dividend, then they would be giving out 10,000 new shares. And that would be considered a large stock dividend. So, what's the difference here? Well, generally the rule is greater than or less than 25%. So if it's less than 25%, it's a small, and if it's greater than 25%, it's a large. Now, why do we really care about this? Why is there a difference? Well, we'll get to that in a minute. So let's say these are our stockholders. Before, we're going to go with the 10% example. Before the 10% stock dividend, this is how the company's ownership looks. Cam owns an eighth, Jill owns an eighth, Tia owns a quarter, and Carl owns half. The small stock dividend comes out, 1,000 new shares are distributed, and so Carl gets 500 of them. He owns half the company, he gets half the new shares. Tia gets 250, which is a quarter, and then Jill and Cam get 125 apiece. So after the stock dividend, right, even though the percentage ownership doesn't change, the pie is a little bit bigger, right? It looks exactly the same. The owners who received the stock dividend didn't get any benefit as far as a greater percentage ownership, right? Everything just got a little bit bigger. So before, we had 10,000 shares outstanding, and if the stock price was 200, right, at that point in time, then there was $2 million in value out there. If we increase the number of shares that exist, that the stockholders have to fight over, the price will, as a result, come down. And so with 11,000 shares out there now, since there's 1,000 new ones, the market is going to correct the price, okay, down to 180, 182, basically. Because what's going to happen is the value overall is not going to change. The $2 million value is still going to be there. So the percentage ownership doesn't change, and the total value doesn't change. If the stockholders' percentage ownership doesn't change and the total value of their investment doesn't change, then why do corporations issue stock dividends? It's a good question. Likely the most common reason for issuing stock dividends is to lower the market price of the stock and to signal to the stockholders that the company, the corporation, has good expectations for the future. So, stock dividends are generally listed as a percentage, as we said. We care about this difference, this 25% line in the sand, because we account for small stock dividends, and large stock dividends differently. Small stock dividends are recorded at market, and large stock dividends are recorded at par. So, small stock dividends, if there's 1,000 new shares, 10% would be small. It's going to be recorded at market value. The large stock dividend, the 100%, is going to be recorded at par. So we need to look at how that functions. So for example, here on the left, assume the market price of the stock is 200 at this time, okay, before we do anything, and the par value of the stock is $1. Okay, so small stock again at market, large at par. The small stock dividend is going to be given a value of $200,000 because it's going to be recorded at the market price. 1,000 shares, $200, $200,000 value. The large stock dividend, going backwards, the large stock dividend is going to be given a value of only $10,000. 10,000 new shares, but it's going to be recorded at par, which is $1. So this is a tremendous difference, right? There must be some really important rationale behind why we do this. And we'll see in a minute. Big difference, right, between the two ways of accounting for these dividends. Big question. Why? Well, I'm glad you asked. This is from an article from the Journal of Higher Education Theory and Practice, but it talks about stock dividends. It says the concern about small stock dividends over many years and through legal court proceedings led to the 1941 issuance of Accounting Research Bulletin number 11 by the Committee on Accounting Procedure. The Committee on Accounting Procedure was a precursor to the FASB. A revised bulletin was issued in 1952, but the accounting requirements of the revised bulletin were similar to the original. Both seem to be an attempt to discourage small stock dividends, or at least penalize corporations for issuing them. One of the arguments against small stock dividends is that the investors may think of them as real dividends, such that the market price may not adjust appropriately and proportionately for the increase in the number of shares. To discourage small stock dividends, the accounting standards required the capitalization of the new stock issued at its market value. The requirement that small stock dividends be recorded at market value is still incorporated in current GAAP. While the explanation provided might be an objective mathematical answer as to why the outcomes differ, it might not provide a completely intuitive and rational explanation. This is especially true when formal research has shown that capital markets do revalue stock prices when small stock dividends are issued. This research argues against the need to capitalize small stock dividends at the market value based on the assumption that the market does not revalue the stock. So, all that to say, we have accounting rules in place even today that sometimes may not be the best accounting rules for that particular topic, but they're still in place. So, this also brings up a point that many people think that accounting is this black and white subject. That there are clear, always, right and wrong answers. But that's not actually true. Accounting is much more like this. There are definitely some things that are wrong and there are definitely some things that are right. But there is an area in the middle, a gray area, that requires a lot of judgment on the part of those in the profession. It is not simply a black and white subject. Now, small stock dividends, as a result, get recorded like this. We're going to debit retained earnings for the market value of the dividend, take it out of retained earnings, and we're going to record it as common stock in APIC. It's going to be recorded a common stock at par as always, but the APIC amount is the amount above par based on the market value. Large stock dividends are recorded at par, so it's simply a debit to retained earnings and a credit to common stock. So, big difference in the way we account for them, The reason we have the difference is historical, mostly, and as is referred to in that article, research may say, or does say, that the difference really is not needed. I'm going to switch topics here a little bit, talk about stock splits. Stock splits are not dividends, but they achieve somewhat of the same purpose. Now let's say this is our corporation. We have 50 common shares authorized. We have issued 4 shares, and the par value of each of those shares is $1. So we have 4 shares for our 4 stockholders, and the par value is $1. If then we go and we issue or we perform what is called a stock split, these are normally phrased as 2 for 1, or it could be 4 for 1 or 5 for 1, whatever the numbers. But it basically means that for every 1 share you have, that share is going to now be replaced by 2. If it was 4 for 1, then the 1 share you had gets replaced by 4. Okay? And so we'll do this stock split example here when the stock price is at 200. Okay? So we do a 2 for 1 stock split. That means that the 50 common shares we were authorized to issue before has to be changed to 100. Okay? It's going to double. The par value that was $1 before is going to be cut in half. So it would now be 50 cents per share. And the common shares 4 that we had outstanding before, there's now going to be 8. Okay, so what does this do? Well, it reduces the par value of the stock. Okay, obviously we just saw that. But again, once the supply of shares goes up, what happens to the price of the outstanding shares? Before, the stock price was 200. After we do this and double the number of shares that are out there, the market is going to adjust and it's going to cut that stock price in half down to 100. So we may say, well, why do we want to reduce stock price? Well, most of the time, if a company's stock price gets too high to where people who buy them in large amounts are not as willing to purchase them, okay, it becomes, I want to say, almost unaffordable. Okay, then the company may split the stock to bring that price down so it becomes more affordable again. So before, we had 1 share that was $200 and my investment would have been $200, but after, right, I will have 2 shares if I'm one of the stockholders, right? I'd have 2 shares. The market price is going to be $100 then, so my overall investment is still $200. Okay, it's not going to affect my overall investment immediately. In the long term, if they were able to increase the stock price over time again, I have more shares and I will have a greater investment. Now, luckily for you and for everybody, there's no journal entry required for stock splits. It's very exciting, right? Now, switch topics. I want to talk about cap. Not that kind of cap. I'm going to talk about market capitalization. Okay? Market cap. It's not a topic that's in a lot of introductory textbooks, but I feel like it's a topic that needs to be discussed. So, corporations issue shares of stock. Okay? If I'm sitting here in my chair and I think, what would it cost me to buy all the shares? I want to become the sole owner of Carl's Canoes. What would it cost me to buy all the shares? How would I figure that out? Well, I would have to take the number of outstanding shares, how many are out there, and I would have to multiply that by the current stock price. That number, that value, is what we call the company's market capitalization. Or a lot of times we just refer to it as market cap. So, a company's market capitalization is the total value of its outstanding shares. If Carl's Canoes here had 10,000 shares outstanding and the market price of the stock was $50 a share, then the market cap would have been $500,000. Okay? So, what does this mean for us as students of accounting? There are many different kinds or categorizations of market cap. Okay, people who do investing break companies into these groups. So I have some general amounts right here that are going to kind of describe the size of companies in these different caps. So nano cap will be companies that have a value less than $50 million. Okay, now there's no hard fast ranges here. These are some. If you look online, you're going to find different ranges, but these are some that are common. So less than 50 million. Micro cap would be 50 million to $300 million market cap. Small cap companies would be the 300 million to 2 billion. Mid cap 2 billion to 10 billion. Large cap anything over 10 billion. And then sometimes you'll see referred to as mega cap anything over 200 billion, okay, value. So what are some of these companies that you may know? Well, the mega cap companies are the companies like Microsoft, Amazon, Facebook, Apple, Google, etc. The big ones. Large cap companies, Costco, PayPal, UPS, Starbucks, Caterpillar. Mid cap, Casey's General Stores, GoPro, Snap, which is the public company that produces or maintains Snapchat, social media. Small cap, Barnes & Noble booksellers, AMC theaters, Red Robin gourmet burgers. Micro cap, Potbellies. There's a Lincoln Educational Services, and then nano cap, Genius Brands. So I put these in here because obviously as you go from right to left, right, as you go from mega cap to nano cap, the companies become less recognizable. Okay, everybody knows the mega cap companies, right? But micro cap, nano cap, maybe they were companies that people have never heard of, right? Or that a large majority of people have never heard of. So looking at market cap here in 2018, here's the list of the most valuable companies in the world. So in 2018, in millions here, you have at the top of the list, and they've been at the top of the list for a while, Apple. Apple was the first company in the US or anywhere, I believe, to reach $1 trillion in market cap or value. And that happened on August 2nd, 2018. Amazon, we know. Microsoft, many of you probably have heard of. Alphabet is actually Google. They had a kind of a corporate name change a little while ago. Berkshire Hathaway is Warren Buffett's company, if you know Warren Buffett or have heard of him. Facebook, obviously Alibaba, is China's eBay, Amazon/PayPal company. Tencent is a social content digital platforms. Tencent is Chinese company. They're the makers of WeChat, which is a social media messaging system. It's also used for payments. And then JP Morgan Chase is a bank, and Johnson & Johnson is obviously Johnson & Johnson. So those are the top 10 as of third quarter 2018. Now Apple hit the 1 trillion mark when they had 4.8 billion shares outstanding, and the stock price hit 207.05, and so they had a market cap or a value of $1,036 million approximately. So first company to hit it. We'll see if anybody else gets there. Amazon is pretty close. The company closest to me, where I live, is Caterpillar, and they have a market cap of $75 billion at the recording of this video, and that puts them probably somewhere close to around number 70 in the market cap list of largest values. So not bad. In summary, stock dividends, cash dividends. Oh, this is not updated. All right, well, I'll update it for you verbally. So stock dividends are when companies give out additional shares of stock instead of giving out cash. Stock splits and market cap. I didn't update the slides apparently. Okay, So stock splits are when a corporation adjusts its corporate charter and increases the number of authorized shares, reduces the par value, and gives out new shares in exchange for shares they'd previously issued. And market cap, again, is the total value of a company's shares that are out there. So if a company wants to know how valuable they are or how valuable the market perceives them to be, the market cap is the market cap is the calculation, right, that you would perform to figure that out. Now, most of the time you don't have to calculate it. You can just simply Google it and you can find the number. So, as always, remember,